Hi everyone, my name is Mark Quinn. I'm a tax advisor and chartered financial planner living and working in Portugal, and I help expats relocate or who are living here manage their tax and financial affairs. And in this video I wanted to just share a very quick example of a tax saving or planning strategy arising from a meeting I had recently with a client who was looking to sell a piece of land in the UK, and it also ties in with inheritance tax planning. So the client I met is regarded as a non-long-term UK resident. Now I've covered this in a previous video, but just to recap, the basis for assessing UK inheritance tax now is no longer based on one's domicile. It's now purely a residency-based test. So once you've been outside the UK for 10 out of the last 20 tax years, you're considered a non-long-term UK resident. And as such, you don't have a UK inheritance tax obligation. The only exception to that is UK-based assets, so UK-based property, pensions, bank accounts, etc. Now, this lady was looking to sell a plot of land in the UK and gift her children part of the proceeds, so she was going to retain part and gift part. Now, under the new rules, the new UK IHT rules, if you gift money to somebody, generally there's this 7-year rule, so it stays inside your estate for 7 years after the date of gift. Now that only applies if you're gifting a UK asset. So assuming you're now a non-long-term UK resident, you don't have the 7-year rule. The only time it applies is when you're making a gift of UK property or cash. So it's a very simple case of tax planning here, and I had to check this with a tax lawyer we work with to check there was no loopholes, but she was considering gifting the cash proceeds of the land sale in the UK to her children. So that would be a gift of UK cash. The sale proceeds of the property gets paid into a UK bank account, and then the lady gifts the UK cash to her children. Now in that case, even though she's a non-long-term resident, because she's not been resident in the UK for 17, 18 years, the 7-year rule still would have applied. However, if she gifts non-UK cash, so if she transfers that cash to a non-UK source, such as Channel Islands, Isle of Man, even a Portuguese bank account that can facilitate sterling deposits, and then gift it, she has no 7-year rule. So I thought it was an interesting and very, very simple but effective form of planning, and just something for you to be aware of. If you are making gifts and you are or you want to become a non-long-term resident in the future, just be cognizant of gifting non-UK assets and cash rather than UK-based cash and assets. I hope this helps.